So perhaps playing off the value growth debate, let's talk about ESG, environmental, social, and governance, which continues to be a red-hot engine for ETF investing this year. ESG ETFs, they've seen record inflows throughout the pandemic. And Luke Oliver says this is actually just the beginning. He runs a suite of ESG ETFs, including the X-Trackers S&P 500 ESG ETF, ticker SNPE. So Luke, let me ask you, why is this trend here to stay?
Well, thank you for having me on. This trend has really established itself this year in 2020. And with over 19 billion has flowed into ESG ETFs this year, and bringing the total to over 40 billion. And so just to put that in some context, there was less than 8 billion in inflow last year. And prior to that, the flows were very scant. And we've also seen a huge amount of new products come to market that offer people access to ESG. So we're really seeing this develop, and investors are really taking note. And as you said, not only have we had large inflows, we've also seen those large inflows occur persistently through this year. And in a year where we have had a huge sell-off and something like a V-shaped recovery, that's pretty incredible to have a persistent addition to a particular segment of the market. So I think it speaks to the fact that investors are adopting this, and they're adopting it less so as a satellite, very specific position, but as something that they'll put at the heart of their portfolio. So that's been really promising. And about 70% of that has gone into large cap domestic ESG ETF. So this is certainly becoming very mainstream in the largest benchmarks. And you mentioned the S&P 500. We've also seen ESG come into its own this year and really stand out and show that it can outperform. And we've seen over 200 basis points of performance over the regular version of the S&P 500. So it really speaks to the fact that ESG is not just a values-based way of investing, but in fact, it speaks to this being very much not a conflict of fiduciary duty. This is a way to analyze companies from a value perspective, but also from a performance perspective, because these ESG factors are actually quite intuitive when you look under the hood. But as far as what's really creating the catalyst for people, I think it speaks a lot to the news cycle. You can't put on the TV without seeing environmental issues, wildfires. We're seeing, social issues across this country and in others. And we've also had recently some big headlines around firms that have run into trouble with corruption or fraud. And so these are the topics that people are seeing, and people are beginning to use those values. And with the growth of ESG, they are now able to express those when investing in the market. And as I said, what's changed this year and made this very mainstream is that access to ESG has shown that you do not have to give up risk and return in order to invest in ESG. And so that mainstream trend is set to continue. And I expect that the growth of ESG not only continues, but accelerates.
All right, Luke, some interesting numbers there. Inflows ballooning to 19 billion this year, doubling year over year, and actually outperforming the S&P by 200 basis points. We're going to bring back in Todd. Todd, what is your take on this as far as ESG investing? Is this a longer-term trend that you see people continuing to put money into?
We do. We are at CFRA hearing from our wealth management clients that they're building strategies that have an ESG option for their clients and a non-ESG options. And as firms like DWS and iShares and Vanguard build out a whole suite of products to give exposure to the U.S. large cap, to developed international, to emerging markets, and as well as fixed income, it's likely to grow. And I just want to touch on what Luke mentioned about the outperformance. People think you have to give something up, but SNPE is outperforming. ESGU, which is an iShares U.S. large cap product. ESGV from Vanguard is also outperforming, also in part because of the heavy weightings they have in Apple and other growth-oriented companies. But it just shows that holdings do drive performance, not just the label.
So, Steve, turning over to you, we were just looking at some ESG ETFs, all of them up about 1.5% today. Do you see that growth continuing long-term, even with a recovery?
Absolutely. And just to echo what the other gentleman had been saying, you're starting to see the momentum in the market definitively in this space. It's just something where if you look back onto BlackRock's Larry Fink, this has been one of his initiatives, and he has said that the top issue for investors has been sustainability. They have $7 trillion in assets. So if someone like a BlackRock starts to dictate direction in the overall market, the rest of the market will follow where he is leaning. And Frank, when you look at the performance of the XLE in the energy space, I think it's one of the very few ETFs that's actually down on a 5-year basis. Everything is fossil fuels there. So when you start to look at what investors are looking for, they're looking to avoid fossil fuels. They're looking to get more into solar for the environment. And when you see California now mandating on all the new builds that they're required to have solar panels, and then there's a push for another 9 or 10 states to follow suit, you definitely see where the puck is going, and this is a major priority for investors. My only pushback would be, how arbitrary is it going to be for these companies to say that they're ESG? So when you look at these funds and you look at Facebook as a top holding, or Apple or Microsoft or Amazon, when you look at Facebook in particular, people can argue that from both sides on the governance issue, as well as other aspects of ESG. So I do believe that this is going to be something going forward that investors are looking for, and I do also believe that there's going to be a debate over what companies are truly ESG compliant.
You know, Steve, that's a fantastic point. I'm actually looking at the S&P right now. Top holdings are Apple, Microsoft, Amazon, Facebook, and Google. So I'm going to toss this back over to you, Luke. Is there just a stark difference between an ESG investor and someone who's investing in tech or growth or anything else when you look at the top holdings of something like the S&P being all these big FANG names and Microsoft?
Well, there shouldn't be a difference. What we want to offer people is the ability to get an exposure to a benchmark like the S&P 500, but to do it aligned with their values. And in line with those values, there's potential for outperformance. And I think that the point made just now about energy companies, you will still find energy companies in these ESG ETFs. It doesn't mean we avoid a whole sector, but what it means is we'll filter that sector and look for companies that are better prepared and better positioned and better performing in ESG terms for the market. So really, this is where I come back to this. There's a capitalist endeavor behind ESG, because they give you companies that are better prepared. So we certainly aren't offering someone by being ESG, you're not moving to something aggressively active or aggressively away from the benchmark. We want people to have the risk and return that they're used to, but do it in an ESG fashion.